What's up, guys? I'm Jaime Tejera, and this is the Nerd Report for Jacksonville, Florida, and surrounding areas for October 2022. Let's get into it. I'm Jaime Tejera, co-owner of Property Bear here in Jacksonville, Florida. This is Carrie Hustis, co-owner and sales leader. While Carrie runs all things sales, my day-to-day hunting investments and developments keeps me in two main places. In the field, checking out potential opportunities in construction, or on the computer researching hyperlocal data. So if you're looking for insight on Jacksonville real estate, you've come to the right place. Thanks for checking out our channel, and if you like it, please be sure to subscribe. So the first thing we are going to go over is, what we're buying. We're still buying the same things. We're underwriting lower than we were. I think last month and, the last 4 weeks of videos that we've been doing, we've been talking about what we're projecting as far as, pricing. And I think we're seeing it. I think we're going to go into those numbers. But today's great because it's the first day of the new quarter, first day of the first month, or first day of the new month. And so we're going to be looking at the monthly numbers instead of the weekly ones today. But as far as buying, still single family, we're looking for about 8-acre land sites for new communities. And we are looking for those distressed apartment buildings that need some work. We'd love to get our crews working on those. So let's take a look at our sales price. So let me make sure I've got my filters. Yep, so I've got my 3 counties, Clay, Duval, St. Johns counties. And we're looking at, last month we saw prices come down. Basically the peak being July. If you sold in July, good job. June, July, August, 365 and 350. So I want to say we started talking about a 10% decline from a month ago. I don't want to say we called the peak, but I want to say a month ago. And so let's say if we're going, if pricing were to come down 10% from the peak at 375, you're looking at about a $40,000 dip, which would be what is that, 335. So 335 puts you at February of this year price point, which is still, let's say we cut off this peak, right? You're still at all-time highs basically for these markets since 2017, and we kind of know what was going on before then. So that's awesome, right? And I'll show you some other numbers, that kind of put things into perspective. Now, let's look at this. So we're down 4% from last month, and we're still up 11% year over year. So at 350, that's a $25,000. So that's what, 7.5%, something like that, from this little peak right here. I still think the overall number is going to be 10% for us by the end of the year. It might be a little bit more. Keep in mind, I still do think that we're going to have some sort of Fed pivot either at the end of this year or the beginning of next year, which puts us in a position for, to see a spike in activity. Let's say summer of next year. Yes, I know that coincides with selling season and seasonality, but I feel like it's just going to be how the world works. It just happens to happen at that same time. So, all right, so we've got sales price there. The next thing we're going to go over is months of inventory. Even though we talk about this, I really don't like this number because, or this statistic, because it's a lagging indicator. So while it might say 3.6, I would say we're probably, I would say a month behind. We're probably at 4.5, maybe 5, right? Because the thing is, people use this statistic to say, hey, we're still in a seller's market. But realistically, a seller's market, like, what's the objective definition? Do I have leverage as a seller, or do I have leverage as a buyer? Right now, the truth is, as a buyer, you have more leverage, albeit it's a higher interest rate and you're having to combat that. You don't feel like you have a lot of leverage, but from a buyer-seller standpoint, the buyer has the leverage, even though the bank is kind of like twisting their arm at the same time, if that makes sense. It just doesn't feel like you have leverage. So let's look at, so you got month supply of inventory. Let's look at our active inventory. And you can see inventory, month over month going up. So as a buyer, yep, this is good news. You have some options and you can get some leverage. Let's go into days on market, and I'll go over what all this kind of means, as a buyer or seller. So you're at 37 days on average. And obviously this coincides with those peaks that we saw, right? Even February 2022, you're at 14. So we're more than double that. Okay, so this is closed sales in general, right? Nobody was talking about a market crash in December or January of 2019. You know what I'm saying? And, January, December of 2018, right? And you can start seeing it decline, obviously, right? The thing is that what you are seeing here is that you're starting to establish, you've got higher highs from a yearly standpoint, and then we're starting to trend back down, right? So lower low, lower low, almost reading it like a stock chart. So I think that coincides perfectly with the interest rates that we're seeing, and basically the Fed trying to stifle the demand, right? So it's definitely working. Now the thing is that prices starting to come down, even though in my mind, if they came down to this 321 level, we're still pretty good. We would basically be wiping out all of the gains from 2022, right? But it's still not terrible. And here, I just want to put things into perspective. Here's the chart for the S&P 500. If you would have put, let's say, I don't know, it doesn't matter what amount, right? $50,000 down on a house, or $50,000 down on a, in the S&P, you would be down 25% on your money, right? Keep in mind that in real estate, it's usually leveraged, but let's pretend you're working with cash, right? And you buy the average home at 300,000 and you pay cash. So even if you go down 10%, right, that would also assume that you were buying in July, right? So, and yes, I know I see a peak, but you're still lower than you would have been in July. From a year-to-date standpoint, if you would have put that in real estate, you would still be up at this point, right? And if we do wipe away all the gains from 2022, you're still at zero versus, being at negative 25%, which someone is. You know what I'm saying? Somebody made that bet. Somebody's not paying attention. Whatever, right? They're like, just throw it into an index. But the other thing is, talking about the rates, we're probably going to get, CPI again. I want to say they're talking about a 50 or 75 basis point hike for the next, for this month. And so you'll see rates go up again. Yes, every time they hike it goes down a little bit. Here's the thing, and this is the bet, right? The bet is that they're going to, if you notice what happened last week or the week before with the UK, they started doing some quantitative easing with the equivalent of their treasury bonds, and then markets kind of rallied, right? That's them. That's the Bank of England, not the mortgage company in our market center, but like basically their version of the Fed, pivoting, right? And at some point, with real estate being 15 to 20% of the U.S. economy, they don't want to see that much unemployment. And what they're looking for as unemployment is people getting back into the workforce that aren't, right? Them getting squeezed financially and coming back in. They don't necessarily want, people to feel a lot of pain. But you are going to feel it in real estate because at times, if there were construction starts in July, right, those invoices were paid for at July prices, and then they're going to have to sell over here. That's just part of the business, right? And it sucks, but there's going to be some losses there and probably some unemployment that comes from that, even just 10%, right? Because they don't need as much staff, things are slowing down, blah, 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 blah. But again, relatively speaking, if the market dipped 10%, you're still up year to date. Um, and for me, I would just think if we wiped away all the gains from 2022, it's not the end of the world. You know what I'm saying? 2008, you know, you had you had people in very over leveraged positions. Here's the thing: people that bought in February, March, April, they're still at lower interest rates, than what the rate is today. The crazy part about that is that they're not in a position where if they sold, it actually makes sense for them. They shouldn't sell because, and I'm not even just talking about pricing. I'm talking about the cost of their home, like housing expense for them is still lower. Even if they bought here in April, it's still lower than if they bought this 350 at today's interest rates, right? So what does this mean for buyers? If you're a buyer and you can't qualify, or you're on the threshold of qualifying, I would recommend buying sooner than later because remember, we're talking about housing expense. If you're trying to time the market and buy at whatever your perceived bottom is, usually doesn't work out for people statistically. But you might miss your next window because the thing is that once these prices drop, it's almost like having support levels in a stock. What ends up happening is that the funds and institutions jump back in and they start buying houses and you don't have an opportunity to buy, especially in that entry level. And then if you're a seller, it means that nobody's day trading houses. You know what I'm saying? Like wholesalers potentially could be viewed that way. But as far as like buying, like it's not possible to like, buy here, sell here, blah, 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 blah. You can't do all that. Most of the time, at the minimum, people are living in their houses for what, 1 or 2 years at the pure minimum, right? So even back here, your January 2021 to January 2023, even if it comes down to this point, I mean, you're still talking about a pretty big jump, right? That's still $70,000 on the average price point. So, and talking about housing expense here, if the Fed does pivot at some point, Q1 of next year, in the summer, you're going to see lower rates, and then you're going to see people jumping back into the market, which is going to make it harder for people to buy houses. Why not lock up a basis today on a property and then refinance it, once those rates do come down? You've already secured your house. All you're doing is lowering your housing expense. But again, if you're on the threshold of qualifying, I do think that these rates are going to keep going up till the end of the year and possibly into Q1. I don't know. I do think that the Fed's going to have to pivot in Q1, and then you'll see a change, by the summer for interest rates, probably in the 5s, 6s, somewhere like that. Because a lot of people are thinking pricing is coming down because all these people are going to be in trouble. The problem is it's hard for these people to get in trouble. And I forgot what the number was, but it was like, I don't know, 85% of homeowners have like rates under 4% or something crazy. Like it actually costs them more to default on a loan than it would, it like doesn't financially make sense for them not to make their mortgage payment. It would cost them more. But percentage of distressed listings, it's still under 1% for all of the markets. And you can see it in different markets. Your highest, default rate is 600 to 749, which I'm honestly not surprised. And then you've got your lower ones here. But in your median price point, it's very, very low. Almost it's negligible in some of these price points. 1.3. That's interesting. Again, not super surprised. And then percent of cash sales. For some reason, it doesn't let us break it down like we wanted to, but we found this price distribution, which is cool on the monthly chart, which is pretty awesome. So percentage of cash sales, you can see it's pretty evenly distributed, except for that, 200 and under, and then obviously the 1.5 and over. Overall, under your 400 is basically your hedge fund target. So as far as like what they're targeting, that's what they're going to be going after. Most of your entry level, like real estate investors are targeting this under 200 range. there are some funds that are also participating in this price point. So, I mean, 90% of homes under 100,000. This doesn't really have to do with institutions or investors. This is just the fact that most lenders aren't doing loans under 100. They definitely will do them. It's just not as prevalent. And then here you've got half of the homes under 200 sold for cash, and then 22%, 24%, 21%. And this is usually where the institutions live, right? And that's one of my points with entry level home buyers, that you know once there is a dip in this pricing, these numbers will go up, and it's going to make it harder for entry level buyers to get in. So while buyers do have some leverage, I would use that leverage to be more discerning as far as what credits and benefits you can get from the seller from a purchase price or point buy down standpoint, versus the actual house, because you may not have those choices later on. That's basically the monthly report for last month. All of the numbers we're looking at. Again, if you're selling, if you're a move up buyer, I can't stress this enough. There's no reason for you to sell. If you're selling second property, inherited property, something like that, it's definitely still a time to look at it. Just don't expect, what your neighbors got, 4 or 5 months ago, where it's like a feeding frenzy. It is going to take, marketing the house properly and doing it the right way. And from an industry standpoint, I do think that because the market requires more work and more professionalism, we're going to see a lot of agents exiting the market, which could potentially contribute to that unemployment rate if they're starting to look for their version of like a real job for them, and that could help with the inflation numbers that the Fed's looking for. But I don't think there's going to be that many agents. I mean, in Jacksonville, you have 11,000, 10,000, whatever. Even if that number cut in half, it's still a lot. Just keep that in mind. Days on market. Make sure your expectations are in line for what it's going to take to sell it. And if you have the benefit of low leverage, consider keeping it, renting it out. And our guys can help you do that. We don't do property management, but we can point you in the right direction. So hope that was helpful. And if you need any help, let us know.